Hey guys, welcome back to the Capital Mindset Show. Today's going to be a conceptual update on stock splits. So I know that the Capital Mindset community, a lot of you guys are financial professionals or accounting professionals or just basically highly enthusiastic people regarding finance and accounting or stocks. Okay, so this is more targeted for that newer investment. We're going to talk about what the heck is a stock split and why are we talking about it. It's because Amazon did a stock split. So if you actually take a look at Amazon here today, they did a stock split. It's $124.79. If you were to take the stock price and you were multiplied by 20, you get something around $2,400-ish dollars. That's where they were trading at just the other day. They're up about 1.99%. Now they might be up 1.99%, unfortunately, because there's a lot of volume, or maybe a lot of volume coming in because people are buying. I hope not that that's the case, but basically, to simply put, this is as simply as I can put it. Before you had one share, and now you're going to have 20 shares. Okay, so 20 shares. So 1 share to 20 shares. That's basically what you basically are getting. The value does not change at all. So value today is equal to the value of yesterday. Okay, what does a stock split do, and why do people do it? Well, people do stock splits because it might actually increase the ability or liquidity for investors to kind of sell off some shares. So before, I would sell 1 share and I would get $2,400. Let's just round it out. Okay, so $2,400. And let's say I don't need $2,400. I want to make a more specified sell order. And now 1 share gives me $124. So I don't have to sell nearly as much of a position. I actually have to sell 1/20th of the previous holding to get the same amount of money. Okay, I get basically a more divisible number is what I'm trying to say. So this greater division, okay, this greater ability to divide gives us more flexibility as shareholders. I don't have to sell as big of a position in my portfolio or as a large percent of my holding as before. For example, if we actually think about Berkshire Hathaway, and I'll actually pull them up here. Let me actually switch us over to Berkshire Hathaway. Because if I pull up BRK.A, okay, you'll see $468,400. Let's say I held 2 shares. Okay, 2 shares is close to $1 million. Okay, $1 million in valuation. Now, why would I prefer maybe Berkshire Hathaway to split? And I'm just making the case here if I were wanting to sell some of my shares. Well, the thing is I only have 2 shares. So if I were to sell 1 share to take some profits or to spend that money, let's say I only wanted $10,000. Well, that restricts me because I have to sell 1 whole share because I only have 2 shares. I cannot sell a fraction of a share in this instance. So by creating, and they created this form, which is basically you get the similar exposure, but instead you get the smaller base. Why would this exist in the first place? Is to provide investors with a greater flexibility, and also in some instances you can think of it as a higher ability for people to accumulate in nominal terms, but it doesn't change the value of the stock. And that's why you want to separate the price versus the value, okay, in the literal sense, and not necessarily in the stock sense, like, that's a cheap stock, and then the price. No, price and value, so you have to separate those two, okay? Because Berkshire Hathaway okay, let's go back to the A, trades at $468,400 doesn't mean it's expensive. In fact, it could still be cheap. It is expensive in the nominal sense, but not in the real sense, which is really important to keep track of. So how does this change for Amazon, right? Amazon's now switched well, not ticker, but it's switched in terms of the share price. I'll tell you that I think back in 2019, there was an article that came out that said if Apple had never done any splits, it would be worth somewhere close to $60,000 back in those prices. And if you remember, Apple today is about above $100, right? So it's rather affordable in nominal terms, okay? So you don't have to commit too much to buy a single share of Apple. Now, with modern technology or modern brokers, you can buy fractional shares of most stocks, okay? So even back then when Amazon was trading at $2,400, it was the purchasing that didn't promote a problem. It was the selling, okay? So that's why if you ask yourself that question, well, why would they do it? What's the incentive? It's just to provide greater optionality for the investor base to sell off some shares, because not everyone can sell off a fractional share. And I think most brokers, if not all brokers, do not allow the selling of fractional shares. Okay, you might be able to name some down below, and I'd actually welcome you guys to name some brokers that do allow that if you find one. But off the top of my head, because I never tried to sell fractional shares, I'm pretty sure most brokers do not sell fractional shares or allow you to sell fractional shares. They're allowed to purchase fractional shares. Okay, so that eliminates the complexity of purchasing, but not the complexity of selling. Okay, so under that notion, we can kind of expand upon this and kind of say, okay, well, with Amazon, what's kind of changed in totality? What will I be able to buy more? Not necessarily. It doesn't affect me, but maybe if you have a smaller portfolio, let's say you're a younger investor, you're just starting out with your first $1,000. Okay, so if you have $1,000 to invest, and right there, okay, I was like, why is the pen not working? There we go. You have your first $1,000. When it was $2,400, you could not make that purchase necessarily, right? And again, we're excluding the fact that fractional reserve investing allows you to do that, okay? We're excluding that. Now you can buy whole shares, right? Because now the price is 124, right? You guys can see that 124 goes into 1,000, but not the other way around. This does not go into 1,000. Okay, this is because it's greater than 1,000. Easy math. All right, so and so when we are allowed to actually allow the user, because again, there are still, believe it or not, some brokers out there that do not allow that. It allows that younger investor to get some shares of Amazon that otherwise they wouldn't be able to, because again, in nominal terms, they don't have the money for it. Okay, so but remember, the primary reason is because it allows the investor, so it allows me to have greater flexibility should I decide to sell off some shares. Okay, before I had X amount of shares, because I don't reveal the size of the portfolio. I saw that some of you have been guessing the size of the portfolio. I will never confirm or deny it, but you guys can always feel free to. But I'm just letting you know, I'm not going to confirm or deny that ever. But yeah, that's pretty much the lesson that you should be had here today. Short, quick, 7-minute video on some shares here splitting. On that note, guys, thank you guys so much for watching. If you guys enjoyed this video, feel free to leave a like. Also, I want to also make an announcement. So, if you stay to the end of this video, I will be starting a series every Friday where I conduct this is basically going to be the Capital Mindset course, and it's going to be starting this Friday. So the first video will be released Friday, so look out for it if you guys are interested. And it's going to be covering from the basics, and then eventually we're going to get into the more complicated stuff. And it will be going over the course of, I don't know how long it will take, but we're going to get there. And again, it's going to be the same design structure as I've stated before, and as promised, it will be available on YouTube. Okay, so on that note, guys, thank you guys so much for watching, and I'll see you guys on the next one. Bye.